I don't think I can remember the last time Alibaba Group reported earnings and the stock actually went up. We'll take a look at their Q2 results, which came out this morning, take a look at some important news that came out in the press release over at Alibaba, and as always, take a look at the technical charts. This one has broken through a key level of support, and I expect further downside for this stock. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. We are on the road to hit 700 subscribers, and your support would mean a lot. Alibaba Group trading underneath $80 once again as shares declined over 9% in the trade. Now, the big reason for that is because Alibaba shelves cloud spinoff, citing US chip restrictions. So in the subsequent, I think, past 2 quarters, Alibaba had said that they are going to spin off their business units into 6 separate companies, but now the cloud unit spinoff has been shelved. As Alibaba said, they believe that the full spinoff of the cloud group may not achieve the intended effect of shareholder value enhancement, and they believe that it's better to focus on developing a sustainable growth model for the unit under the fluid circumstances. And so the big reason why this cloud unit has been shelved, the spinoff for this unit has been shelved, is because the US have curbed the export of NVIDIA's AI-focused H800 and A800 chips to China back in October, and those chips are critical for this cloud unit. We know companies like Microsoft, Amazon, Google, all of them use NVIDIA's chips to power their cloud technologies, and certainly Alibaba would have done the same, but now these US chip exports have created uncertainties for that group. And we'll see when we take a look at their revenues by segment. You see Cloud Intelligence Group actually only grew 2% in this most recent quarter, as revenues for that unit came in at $3.7 billion. That is in USD for 3 months ended. Again, 2% growth is not good enough. Let's just say it how it is. Frankly, AWS is growing in low double digits, I think at 12%. Microsoft is growing in the high 20s, and even Google Cloud is growing at nearly 22%. And so just 2% growth on Alibaba's cloud unit, which is now their second biggest unit from a revenue and profitability standpoint, right behind their Taobao and Tmall group. Yeah, just 2% growth on that is frankly not good enough. And considering now US chip exports have been curbed for these NVIDIA AI chips, yeah, if companies like Microsoft, Google, and Amazon are all going to be using these chips, Alibaba's cloud unit will simply not be able to compete with clouds such as AWS and Azure. And so again, Alibaba's cloud won't be able to gain market share. They're just going to be left behind, and this growth in this unit may slow down even further. And so this is a big unit for investors considering profitability and revenues. And if this unit is only growing 2% and is expected to, again, not have its own IPO, that some of the parts valuation won't be unlocked for this cloud unit, yeah, that's certainly not a good sign to see for investors. In terms of their other segments, Taobao and Tmall, which is their largest segment from a revenue perspective, grew at just 4%. The Alibaba International Digital Commerce Group did grow nicely at close to 53%, and all of their other units did post solid growth on their top line as well. Now, the other piece of news over at Alibaba was that they declared a $1 US dividend. Yeah, that's right. Alibaba paying a dividend for the first time ever. That dividend is approximately $2.5 billion on an annual basis. And so US $1 per ADS, we come down to Seeking Alpha, and they actually do this really helpful thing where they post these hypothetical projections for dividends. And so we see $1 on a US basis is likely a bit higher than 1.14%. I'd say close to 1.2% of a dividend yield for Alibaba. That's a payout ratio of just over 10%. So again, Alibaba expected to do $9 in forward EPS and is now expected to pay $1 annual dividend. That not a big payout ratio for Alibaba. We'll come take a look at their free cash flows. Certainly doable over at Alibaba considering how much free cash flows they generate. Just interesting to see them paying out a dividend. And the other big news is that they bought roughly $1.7 billion worth of their common stock back in this most recent quarter. They still have nearly $15 billion remaining on their share repurchase program effective through March of 2025. And in my opinion, so my thoughts on this dividend are basically, from one perspective, it does make sense. Alibaba, I think, is trying to cater to a different shareholder base, considering their shares are trading at a very cheap forward price to earnings of close to 9.5, maybe even 9 times a forward price to earnings. Yeah, their shareholder base right now, I think they're catering more towards a value shareholder base, considering that they're paying off this dividend. In the past, Alibaba has been seen as a growth stock in the market, And certainly real growth stocks don't pay off dividends. And so I think they're trying to expand their shareholder base to attract more value investors that see a dividend and see that steady income, and they prefer that. They also have the money to cover a dividend like this, just around 15% of their payout ratio at just $2.5 billion annually. So certainly from that perspective, it does make sense paying a dividend. But from the other perspective, I can see growth investors being unhappy with Alibaba paying a dividend, considering their shares have been declining by nearly 50% over the past 5 years and are down substantially from their all-time highs. I think growth investors would rather see Alibaba continue to do their share repurchase, maybe increase this to $2 billion, $3 billion, $4 billion if they can over these next few quarters, as reducing their share count will continue to grow earnings over at Alibaba. And so I think there's two camps you can see and like this dividend if you're more of a value investor, considering the valuation of Alibaba is trading cheap, and I think they're trying to cater more towards value investors as well. And they likely, frankly, just have too much cash flow flowing through the business, and they frankly don't know what to do with it. From a growth perspective, I can also see why this would not make a lot of sense, as Alibaba could just continue to repurchase more and more shares, considering how cheap their stock has been trading. Now, from a quarter perspective, Alibaba posted revenues of $30 billion US. That was an increase of 9% year over year. That also came in line with analyst expectations on Wall Street. They also increased their adjusted EBITDA on a non-GAAP basis by 18% year over year. That's very good to see. And you see diluted EPS on a non-GAAP basis coming in at $2.14. That was up 21% year over year. That also beat estimates on Wall Street by roughly 4 or 5 cents. We see net cash provided by operating activities for these last 3 months coming in at $6.7 billion and free cash flow coming in at $6.2 billion. That is up 27% year over year. Again, $6.2 billion worth of free cash flow, and Alibaba declared a $2.5 billion annual dividend and bought back just under $2 billion worth of their common stock. So again, on a free cash flow basis, this company is looking very strong. They easily have the room to improve this dividend, to increase their share buyback. They have, frankly, a lot of free cash flow. And so from that perspective, Alibaba just has a lot of options to return value to shareholders. And considering they don't have a lot of debt on their balance sheet, we see they have roughly $27 billion worth of total debt, and they're sitting on over $75 billion worth of cash and cash equivalents. So again, very cash loaded. They're just trying to return that cash to shareholders in one way or another. Now, while the fundamentals for Alibaba look great, what doesn't look good is the technical chart. As you see, it broke a key level of support at $80 and it closed underneath that at $79.11. The last time Alibaba broke this and really closed below it was back in May of 2023. It did seem like a fake out where it closed underneath it and then quickly rallied higher. But in my opinion, I think the sentiment around Alibaba has once again turned negative, a nearly 10% decline in a day. That is certainly a bearish move. And considering, I think, this big news of that the spin-off is not going to happen over at Alibaba, I think that is the big reason why shares declined so sharply. Realistically, I think this one is going to come back underneath $70. There is a level of support at $74, but it's not very strong. I think realistically, this one is going to come in the range of $60, close to $62, $63 before it again sees a rally higher. Now, if you are bullish Alibaba, I think you want to see this one come in here and close above $80 and do that fairly quickly. And if it does that, it can see a rally close to $90. I think that's very fair to see for Alibaba. It has been consolidating in this channel between really $80 up to $100 over the past, we'll call it roughly a year. Hasn't done much but consolidate. And so if you want to see Alibaba consolidate back within this range, you have to see a close above $80 in the near future. I think it's more likely Alibaba breaks down and continues to head lower south of $70. The fundamentals over at this company still look great. They're still growing their earnings. They're expected to grow their earnings in the low double digits range over the next few years. They're expected to grow their sales in that high single digits range. And again, they'll continue to likely repurchase their common stock, even maybe increase their dividend over time and cater to that value investor. I think from a fundamental perspective, this company is looking great. But again, the technicals aren't there. And I mentioned this 3 months ago in a video where I did, mentioning that the one reason to avoid Alibaba stock is just the fact that it is a company based out of China, and there's a lot of risk a lot of unpredictability, as you saw from the curb of these US shipping exports. That is the unpredictability nature of a Chinese company, and frankly, owning a Chinese company and a Chinese tech company brings a lot of risk to your portfolio. I think there's a ton of money to be made in companies in the US, like an Apple, like a Microsoft, like an Nvidia. I think there's a ton of money to be made in tech giants in the US, that there's no reason to outsize the risk in your portfolio by owning a Chinese company like Alibaba. While the fundamentals are great, yeah, I think the risk and uncertainty is something that I at least would love to avoid. That was my take on Alibaba stock. Let me know your thoughts on this one in the comments section below. As always, thanks so much for tuning in, and I'll catch you guys in the next video.